Welcome to Tax Insights, presented by Hawkins Ash CPAs.
Good morning, listeners. Welcome back to Tax Insight each and every week here on WOMT with Jeff from Hawkins Ash. Jeff, good morning, sir.
Good morning, Terry.
Qualified business income. That is today's topic for our listeners.
That is correct, because back in 2018, the corporate tax rate was decreased from 35 down to 21%. And at the same time that what you mentioned, the Qualified Business Deduction, or QBI, was introduced. Now, this deduction was really meant to even the playing field between corporations that pay their own tax and businesses that pass their income to their shareholders or partners.
So what type of businesses are eligible for the QBI, or again, the Qualified Business Income Deduction?
So, as I mentioned earlier, the deduction is available for any entity that passes its income through to a shareholder or a partner, such as a partnership or an S corporation. But it's also available for sole proprietors and single member LLCs, where maybe their net income is actually reported directly on their individual return. This could be a business, a farm, or in some cases, even a rental property.
So then how much is this deduction?
The QBI deduction is actually worth 20%. So for example, let's say a business has $100,000 of net income before this deduction. The deduction is worth $20,000. So the owner of the business really only pays taxes on the $80,000. Now, that $20,000 deduction could save almost $5,000 if the taxpayer's in the 24% brackets. I mean, we're talking real tax savings here.
Absolutely. Real tax savings, real dollars for business owners. Does any business income qualify?
The business income really has to be from an operating business that's active. Those are the type of income and businesses that qualify. If you operate a hobby or in some cases a passive business, that income will not qualify.
So then can any business owner take advantage of this deduction?
Yeah, as long as their total income is under the limits of $315,000 for married filing joint or $157,500 for single. Now, these limits include all the income that a person has, both the business income and their other income, maybe W-2s and things like that. Now, if their income is higher than that, it gets a lot more complicated. So that's when you really want to get your accountant involved in order to maximize that deduction.
Gotcha. You said earlier that a passive active activity may not qualify. Are there any that might actually qualify then?
So if you have a rental property, that would be an example of a passive activity. And that's where it gets complicated to determine if that type of business qualifies. If the rental income is directly related to an operating business that's owned by the taxpayer, then it'll generally qualify unless that business is a C corporation. Also, if a business owner or a person owns a number of buildings that are rented, they may not qualify individually, but you can group them together and then they might qualify. So, just by those three sentences, you can tell this is a complicated area, and this is another area where you really want to get your accountant involved.
Absolutely. Jeff, great information. We want to encourage listeners that if they do need to connect with the team at Hawkins Ash, simply go to hawkinsash.cpa. Other ways in how listeners could connect with the team, Jeff?
Sure. You can follow us on Twitter, even like us on Facebook.
Thank you, Jeff, for your time and the information. We'll talk to you next week here on WOMT.
This has been Tax Insights, presented by Hawkins Ash CPAs. Learn more online at hawkinsashcpas.com. Hawkins Ash CPAs, part of your business, part of your life.